in a way, the emerging markets as a sort of concept for higher investment returns is a sort of invalid idea.
Welcome back to Breakout with Breaking Views, brought to you by PGIM. I'm Peter Thalassen, the acting global editor of Breaking Views, London's Canary Wharf. And I'm talking again to Edward Chancellor, who this time is coming to us from West London. This week, like many investors, we are preoccupied with the sharp sell-off in stock markets around the world, but we're looking particularly at emerging markets, which have performed even worse than the tech-heavy US stock market. Eddie, I thought the whole idea about emerging markets like China and India and Brazil was that they offered faster growth than developed economies. So what's going on?
Well, emerging markets were created as a concept in the mid-1980s on the idea that what we used to call the developing economies were going to grow faster and therefore deliver higher equity returns for shareholders. Now, that was actually always a false promise. So there's no theoretical relationship between economic growth and stock market returns. In fact, in the short run, the data actually suggests that countries that grow faster actually deliver poor returns, and countries that have been doing badly, growing slowly, deliver the best returns. So, in a way, the emerging markets as a sort of concept for higher investment returns is a sort of invalid idea. However,
but people did do well out of emerging markets, didn't they?
The most important thing, as you and I know, is valuation. You
right.
buy markets that are cheap, and 20 years ago, emerging markets were very cheap. US stock market was coming down from a bubble level, and over the following decade, emerging equities returned about 10% real for investors, and whereas the US stock markets was sort of more or less flat over that period. So emerging was the fantastic number one big asset allocation bet of the early 2000s. I'm asking in this piece, is that opportunity again here today?
And so, what's the answer? I mean, the emerging markets obviously are quite different now, and you talk particularly about China, which has been included somewhat controversially, some would say, in the emerging markets index, and is now quite a big chunk, I think 30% or something like that of the emerging markets index. So presumably it's a different proposition now than it was before.
Yeah, it is. I mean, on a number of fronts. I mean, first of all, the valuations on offer today, and they're good, don't get me wrong, but they're not quite as good as they were 20 years ago. My old firm, GMO, is forecasting 4% returns, real returns for emerging, which is better than their forecast for the US, which is negative. Research Affiliates has a more bullish emerging forecast of 10% real over the next decade. So somewhere in between wouldn't be necessarily far wrong. But to my mind, the problem actually is, as you mentioned, China's growing weight in the index. When the emerging market indices were created, there was no role for China in it. Now, in the benchmark MSCI index, China has got up to 30%. And I think that's problematic because capitalism in China doesn't really work the same way as it works elsewhere. Since the Shanghai stock markets opened in the early 1990s, total shareholder returns from those markets have only been just above 2% annualized in US dollars. Now, over the same period, the Chinese economy has grown some 33 times. So it shows that categorically that there's no relationship between economic growth and returns. But it also shows something much worse than that, is that somehow or other, China is not delivering the economic returns that shareholders expect and for the risk they take. Now, I also mentioned in the piece that the experience of investors in Russian equities. Now, the Russian weighting in the emerging market index was only 2%. Now, that it's unfortunate, but you can recover from that. You cannot recover as an investor if China, for one reason or another, were taken out. And I think, and if you go back to the course of the 20th century, Russian stock market went down to zero, produced this wonderful long-term data. They've crunched an emerging market index for the whole of the 20th century, and what they show